Hey guys, it's Olivia. I have a hot topic of the day to talk to everybody about, and it is tax values. Unimproved property, improved property, tax authorities, tax rate, taxable value. I have been so fortunate in my career. I've worked with a ton of first-time home buyers. I sold new construction for many, many years. And even in the resale side, this is a really, really hot topic. So I'm going to be very elementary style and just break down some definitions and hope to give some clarity if anybody has any questions about how property taxes work. So when you become a homeowner, you have the cost of the house clearly, and then you have cost of maintenance, and you also have these secondary expenses like property taxes and whatnot. So your mortgage payment is either inclusive of your property taxes, where that monthly payment that you send, I'll just go ahead and break this up really quick. Every month you send one check to your mortgage carrier, and that check goes, here's the money man. You write that check to him, Mr. Mortgage. Mr. Mortgage gets that check. And that check is your total mortgage of, let's just say, $1,900. And that check includes your PI, TI, your principal on the loan to Mr. Mortgage, your interest on the loan to Mr. Mortgage, your property taxes, and your insurance, your homeowner's insurance, and possibly also your mortgage insurance premium. So Mr. Mortgage, he's gonna take his money first. He's gonna hold on to that principal, and he's gonna take that interest, and he's gonna put that in the bank. But this other money, your taxes and your insurance, those he's gonna hold in an account called an escrow account. Every month, he's going to deposit those funds into the escrow account in your name that's associated with your address. And then once a year, he's going to pay those things out. He's going to pay your county taxes. He's going to pay your homeowner's insurance on your behalf. And most lenders require having an escrow payment if you have not put more than 20% down on the property. It's just lower risk for them, making sure, property tax bills in the Austin area are easy, $8,000 a year. A lot of areas, they're $17,000, $18,000, $19,000 a year. So, but wherever you are nationally, no matter where you are, most loans, the lender requires, or not most, maybe many, lender requires the escrow account. So what we're going to talk about though is that portion that is property taxes. Your property taxes, we'll just start really basic. You have a property tax rate. In the Austin area, they're anywhere from 1.9 to about 3.1. So we'll just go really simple and say that your tax rate is 2.5%. Need to add deductions to our conversation over here. If your tax rate is 2.5%, you're saying 2.5% of what? And that is of the assessed value of your home. Your assessed value is a tax assessor evaluating your home, not your market value. So please keep in mind these two things are very different. You always want the lowest possible taxable value and the highest possible market value, of course. But your rate, 2.5, your rate is determined by a lot of things. Your rate is determined by what's happening in the area. So I'll give you an example. Newer developed, new growth areas typically have a higher tax rate. And that's because they are taxing the area for improvements, additional streets, bonds for schools, areas that are very well established. All of your infrastructure is there. Your schools have been there for years and years and years. It's kind of on an autopilot, frankly. A lot of those areas will see tax rates lower, like in the 1.9. But in growth areas, you tend to have your basic tax rate, maybe plus these temporary bonds or these utility development taxes that are on top of a typical tax rate. But anyway, when you get that tax bill, it's going to be all inclusive. It's going to be one tax rate. And then it's going to break down for you your taxing authorities. Taxing authorities are the authorities that receive funds from your tax dollars. And that's typically, obviously, your county, your school district, your emergency dispatch. And then, like I said, any additional tax that might be for some type of utility development fee. A lot of these areas are such new growth that developers will work agreements out with the city to say, hey, we're going to borrow $32 million to start this development. We're going to bring 1,700 homes in. This is so weird. My hair looks red, and it's not red at all. The lighting is odd today. So you have your tax rate, and then what you'll see under your tax rate, and I am totally making numbers up, but you'll see like say 1.3 goes to your county, 0.8 goes to your school district, 0.4 goes to your emergency dispatch. So what's really cool is you have a line item that will bring you to your total tax rate. So you have your assessed value times your tax rate. So I'm just gonna take a house up here that your tax value is, let's say 325, since that's about the median price point in Austin. So you have 325 value times your tax rate of 2.5% would pretty basically equal your annual tax bill. But with so much growth and so many people buying new construction, a term that you're hearing a lot is unimproved property versus improved property. This comes up as early as your mortgage application time frame, when your lender's trying to set expectations to get you qualified and also to give you expectations of what your monthly payment is going to look like. Here's the difference. I've drawn this picture for years, and it's normally in the setting of training folks who are going to be selling new home construction, so I hope that the lingo or the language isn't different. I literally draw a car. So every year, and I think this is going to change with technology now, everything will probably be done from satellites, but every year you have a little dude that drives around, and he is a tax assessor. He goes out, and I say it's a he, I don't know if it's a he or she or how many of them there are, but for visual purposes here, a human being goes and assesses the value of every single property that has a lot and block or a property ID within that county. Every single property gets viewed one time a year for a tax value assessment. So that little dude, he's gonna drive around, and let's just call our address 123 Main. Well, 123 Main might be a cornfield. It looks like I'm gonna need a darker color because I'm gonna tell you can't see that. 123 Main, now this is a bird's eye view, it may be a lot and block. Let's just say that lot is 60 feet wide by 110 feet deep. That lot may be totally empty, or it may have a home's construction that just started that's not completely done. That same lot may have a completed house on it. Depending on the stage of that lot and its development and the structure that's on it, a completely blank piece of land or an empty lot is called unimproved. This completed home is called improved property taxes. So all that means is the value of the land in its current state. So this blank land, this lot, is maybe worth $50,000. Then once construction started on it, maybe it's worth $70,000. Then once that home's completely total, that house is gonna be worth $325,000. It's the taxable value of that land. So your tax bill every year will depend on the assessed tax value the day in which little Mr. Tax Dude was driving around and assessing your property. So what that means if you're buying new construction, if you're buying new construction and you come in and the house is complete and it's beautiful, and you pay $325,000 for it, and the lender estimates your payment, your monthly mortgage payment to include your tax rate, and he may say to you, okay, after your down payment, including your taxes and everything, your monthly mortgage is $1,900 a month. Well, then you get in the house and you get settled and you get your first mortgage statement bill, and lo and behold, your payment is only $1,600 a month. And you say, oh my God, that's awesome. My mortgage guy was wrong. Olivia was wrong. My mortgage is only $1,600 a month, not $1,900 a month. So we are now going to eat out 3 times more a month and go see more movies and buy a second car or whatnot. Hold your brakes. The lenders are required to estimate your monthly payment on improved property. So they are required to qualify you based on your sales price times your tax rate, because that is what your payment should be. If your payment comes in below that, it simply means that the assessed value hasn't caught up yet to the complete construction status. So your tax value based on the county was probably assessed somewhere along the way of construction, either an empty lot or midway through construction. This absolutely will catch up to you. You will very likely receive a bill for that difference, or the following year, your payment will go up. So here's what I have to say, a couple things. One, always pay what your lender told you to say. Two, if you choose not to and your payment goes up, don't complain about it, because the number that's going to be right was the original expectation. From your fully improved property tax rate and tax bill, can your monthly payment go up? Absolutely it can. The terms of your loan can never change. They cannot change. Whatever you agreed to at time of signing, whether it's a fixed rate, a convertible rate, a flip rate, adjustable arm, whatever it is, the loan terms cannot change. But what will change over time is the value of that property. I have owned homes for 20 years. Never have I had a home's monthly mortgage payment go up significantly because of property taxes. Values do go up over time. As a homeowner, you have to understand property taxes are going to go up over time. But the biggest number in which property taxes will go up is that first couple years that you're in a new construction home, the first couple years as you're balancing out from unimproved property to improved property. But even at that second or third year payment, you're just getting to the number that the lender originally set their expectation. My hair is seriously all kinds of out of whack. So that's the difference between improved and unimproved property. I want to make sure I did everything on my checklist here. Unimproved, improved, yes, that's just the state of the lot. Your tax authorities, there's more than one, it's just not the county. Your tax assessor is a little dude that drives by, or satellite images. I'll tell you what they do when they're there. They're calculating the square footage of the lot. They're calculating the square footage of the structure. They are assessing value based on improvements. So guess what? If you built a pool like I did this year, your property value is going to go up, so you're going to pay taxes on it. If you extended the square footage of the home, say you finished out a garage or you built an outdoor she shed or something. So that's why he's going by every year, to see how the property condition has changed and to value and tax accordingly. Market value. Keep in mind your market value is not always going to be consistent. Don't freak out if your tax bill, what shows your tax assessment that shows your value for the year isn't what you think the home is worth. They are two totally different things. If you have questions about your taxing value, call your taxing authority. If you have questions about your property value, your market value, call me. The last thing is deduction. What I did not account for here was any discounts that you might qualify for from your taxing authority. So veterans that have any percentage of disability may qualify for a tax deduction. Folks over the age of 65 qualify for certain deductions. The use of property, if it's your primary residence and not an investment property, you do qualify for, for some discounts called a homestead exemption. So there are deductions and exemptions that you may receive. Each case is individual, but the purpose here today was really just to break down the difference between improved property and unimproved property and why your payment may fluctuate so much in the first 1 to 3 years of homeownership on new home construction. Holy cow, that was 13 minutes. I hope a few of you stick around the whole time. Thanks, guys. Bye.